in this, which is our second annual Military Spouse Symposium. We had to, of course, reschedule because of the pandemic in 2020. So we feel fortunate now to be able to provide this on this platform. So without any further ado, U.S. Bank and Conquering Debt. Thank you, Sandy.
Thank you. Thank you, Philip. Well, happy Friday, everyone, and happy Mother's Day for whoever is out there celebrating Mother's Day on Sunday. And most importantly, happy Military Spouse Appreciation Day. We are so proud and so honored to be here today. So thank you again for including us. So we are talking about conquering credit. And I have my friends, Mary and Antoinette, talking about how to build, how to protect, and how to conquer our credit. So before I hand it over to them, I am your moderator. I am Sandy Porter. I have been with US Bank for 20 years. Yes, I started when I was 5, probably. Again, if you have any questions, we encourage you to use that chat box, and we will do our best to address them. Otherwise, we do have a few minutes at the end of this presentation to take any questions and answers. So Mary and Antoinette have been in the industry for over 20 years, and they are VA home loan specialists and mortgage originators. So they are very well versed on everything to do about credit. So with that, I'm going to pass it over to Mary and Antoinette to get us started on conquering our credit.
Oh, good afternoon, everyone. My name is Antoinette, and I am so appreciative of all the military families. My son and daughter-in-law are in the military, and I know the sacrifices you all make. So thank you so much. And I just want to be of value to you today. If you have any questions, feel free to ask. Mary and I are going to go through the conquering credit with you, and we just want you to feel comfortable and reach out even after this if you have any questions to help you conquer your credit.
Hello, everybody. Hi, I'm Mary, and I work with Joanne, and we are a tag team with US Bank. Two most important things in your whole life are your wealth and your health. And I really love it because before we saw talking about wealth and how to accumulate wealth, and we're going to go a little bit further with that about buying a home and how to make sure you're in a position. So when you get ready to retire, not that you're thinking of retiring now, but down the road, you're ready to retire, you're in a really good position to do that. So we appreciate your time and to be able to help and answer any of your questions. And with that, I'll let Joanne start.
Antoinette. My sister is Joanna. She's also with US Bank. So that's okay. It's happened many, many times. Thank you, Mary. All right, get the scoop. How lenders assess your credit worthiness. What is credit and why does it matter? This is just a summary of what we're going to go through. Learn the 4 C's of credit, how to qualify for the credit you want, what if you don't have a credit history, and 7 ways to improve your credit score. So that's what we're going to cover today. What is credit? Credit's about borrowing money with the understanding that money will be repaid. And financially, it's one of the most important items that you will have in your life. So keep it at a very high priority in your life. It's not maybe how much credit you have, but making sure you have the best credit you can have. And we're going to hopefully give you ideas on how to attain that. Why does your credit matter? Being responsible with your money makes you more than a good citizen. It makes you a good credit risk as well. And if you're a good credit risk, that means people are going to want to extend credit or lenders are going to want to extend credit to you. And it'll help you attain more things in your life. And with good credit, you'll be able to attain these items with lesser money, so a better interest rate. So it's very important for you to maintain good credit.
And then I might add that a credit impacts every single thing in your life. If you think about it, when you go get a job, you get a credit score pull. If you go to buy a car, they pull your credit. If you're renting, they pull your credit. So credit is your identity in a way, and the importance of keeping it good and being responsible reflects on your character when people pull it. Joanne mentioned also the better your credit, the better rates you're going to get. So if you have a lower credit score, you're going to pay more money every month, whether it's a car loan, a credit card, or a mortgage. And that can make a big impact on your life. So we can't stress how important credit is, whatever part of your life you're in, and it'll follow you around for the rest of your life. So it's really something that make the priority.
Definitely.
Hey, Mary, so how do we feel about Credit Karma as a source of retrieving our credit score?
We can get there's many sources out there, which is a really good question. So Credit Karma is one way to do it for free. And it's the one thing I would be cautious of is Credit Karma has different scorecards. So you have a scorecard if you're getting a credit card and you get a score for that. You have a scorecard if you're getting a car and you have a score for that. You have the toughest one you're going to have is a mortgage scorecard, and it's going to take more things in consideration. So when you look at Credit Karma, you're going to get a like 720 credit score. That is like a basic credit score. That is not your overall credit score, but absolutely a good source. If you're in a position where you don't know where your credit is, there are agencies out there that you can purchase and look at your credit is one option. If you're in a position to buy a house and you want to make sure you're in a good position, or the US government allows us one time per year, every single person, one time per year to pull a free credit report. So you can take a look at it and make sure that there's nothing on it. So I was highly suggest that you pull the free credit report, and then you could look at Credit Karma.
I will add.
Now in your,
sorry about that. I want to make sure people realize, I didn't mean to interrupt, but the free credit report is attained by going to annualcreditreport.com. So the link to freecreditreport.com is really a link to get you to start paying for something in the future. So the annualcreditreport.com is where you want to go to get that free credit report.
And we can provide that link. If anybody wants it, please reach out and we'll provide that link.
Absolutely. Now, in your 20 plus years of experience, have you had anyone who had maybe like their neighbor show up on a credit report or somebody different show up on the credit report?
Oh yeah, but you know what? It's heavily regulated now, and we are getting better. And we hear about all that. You know, they're getting really good at getting this stuff. So there are ways, and that's why you want to pull it up. And that's a really good question, Sandy, because that's why you want to pull it up, catch it before it happens, and then you get it taken care of. I recently did a loan for a customer, pulled a credit report, and honest to God, a $29 medical bill on there. And it had just happened the month before. They were able to quickly go back there and get that taken off. So that's why it's really important that you keep up with it and get it corrected. The credit bureau agencies, if you dispute something on your credit bureau, they have 30 days, guys, to get it off. So it's something.
And the burden is on them too, right?
Pardon?
The burden is on the credit agency to be able to dispute that, right?
Absolutely. And they're really good at stuff like that. And we're going to talk a little bit later about what kind of things can muck up your credit. That medical bill is one thing we'll talk about again. And for $29, what it can do to a credit score. I mean, so really important to keep on top of it. Parking tickets too, right? Parking tickets too, pay those parking tickets. City of San Diego likes to put them out there.
Okay, and I love all the questions on our chat, but we are going to move on, and I promise we will get to your question by the end of this presentation. So we will move on to talk about the 4 C's of credit.
Yes, let's talk about the 4 C's of credit. Character is financial responsibility, basically paying on time and handling your credit responsibly. And then capacity is the ability to pay the credit that you've had extended to you. So that would mean, if you go opening a lot of credit cards and go get a car loan, and then you have to pay your rent and utilities, and you have monthly payments that are, more than the amount you are receiving in income every month, that would mean that you don't have the ability to pay. So that's a very important factor. The next is capital, your net worth. So your net worth is the money you have, like assets, like maybe, money in the bank, and maybe you have your car paid off, and maybe you own a piece of property. And that's minus by any loans you have. So your net worth would be the sum of all those. And then the collateral, security for repayment. Some credit is with collateral, such as car loans and home loans, but some loans are unsecured. So they're like credit cards or personal lines of credit where there's not an item that is being placed for collateral for that loan.
So which C has the most impact on your credit report?
I think they're
All of them.
all of them. Yeah, that's what I equally.
They work together. You can't say one is more important than the other.
Okay.
Actually, capacity or ability to pay doesn't really affect your credit score itself, or neither does the capital, but the what does is your character. Because a credit report, think of a credit report as a character report. This is how this person pays their bills on a monthly basis. Are they all the time 30 days past due? Do they pay on time? Did they run out and get 26 credit cards because they could? Not because they needed them, because they could. Did they, do they have a car payment with a $600 a month car payment when they're trying to buy a house? So basically when you're looking at your character, that's our character analysis, would be our credit score. And then when we do the loan for lending purposes, whether it's a credit card or whether it's a car loan or whether it's a mortgage, they look at all of those issues combined together. And then you make a decision based on all those issues. If you have one issue that's a little off, let's say that your debt to you don't have, your income is not quite enough there, but you have an 800 credit score, that's a mitigating factor that's going to help. So that's why you can't really just say, oh, it's this one. We look at the whole thing.
Got it.
And
Okay.
the your character is, like the credit score, I look at it as like your grade when you went to school. So when you're in the 700s or higher on your credit score, that means you are getting A's. Once you start getting lower, you're starting to not get as good of grades. So your character, your ability to pay back, and all the other items are important, but I think the credit score is the one that will hurt you the most if you let that slip. So
character is pretty much your past payment history or your past history with credit. So why are the 3 credit bureaus so different? Why is one score different than Equifax or TransUnion?
Well,
Go ahead.
Oh, I was going to say my answer is not every lender reports to each credit reporting agency.
Right. So mortgage, there's only three, unfortunately for us right now in the world today, it may change someday. There's three people that everybody uses: Equifax, Experian, and TransUnion, like it or not. Okay. And each one of those companies, if I get a car, they may only report to TransUnion and they may not report to Equifax and Experian. So all the credit card companies don't necessarily need to report it. So American Express is a good one. They report always to all three. Okay.
Okay.
And there's some that, like my customer I told you guys about before, who had that $29 medical bill. Thank goodness they only reported to TransUnion, because that was the one that got hit. The other two did good. So that's why they'll vary from store to
They
store.
vary. All right. Okay. So moving on to capacity, right? Which is what you had said, the ability to repay.
Yes, the ability to repay. So as lenders, we have this acronym we use, DTI, debt to income ratio. And basically what you do is you take, I'm going to use easier numbers. So let's say you make, this gives you an example, and we can use this, but I like to use simple or math. And I would say, let's say you make $1,000 a month and you have $500 of bills, creditors, car loans, student loans, doesn't include your utilities, but it would include any type of credit, alimony, child support. Those do affect your debt to income ratio. So let's say you have the $1,000 a month you make every month, and $500 a month goes to paying your car loan, your rent, your alimony, your child support. You are at a 50% debt to income ratio at that point, because half of your money is going to pay off items that count within this calculation. And that is a very high debt to income ratio. You always want to try to stay below 43% for all your debts that are on your credit report, such as your, rent. Your rent isn't on there usually, but it's rent, housing expenses also count. So when you're going to buy a home, I'm just going to put that out there. When you go to buy a home, it's not just your monthly home payment, like your rent payment would be. At that point, then you also need to add your taxes, your property taxes, and your homeowner's insurance. So it becomes more complicated. The more debts you have out there, the more you have to count. And when we run your credit report, we will see your minimum payments that you have due for things like your credit cards, personal loans, car leases. So those are all items to consider when you're going, let's say you're going to get or purchase a car. You should think about, you think it's okay right now to spend, $500 on your car payment when you make $1,000 a month. But for us, that you've already spent half of your money, for your car. And sometimes it's better to go with a much lower payment so you can keep your income available to pay for other things in the future.
And can I just add, one pitfall to avoid, guys, is to be a co-borrower on somebody else's credit. Your brother wants to buy this great RV. He can't go buy the RV by himself, so he has you be a co-borrower. Guess what? We consider that your debt, as if you own it 100% of that debt. So that can hurt you when you're going to look for a house, or to be, a co-borrower on your kids' credit cards. Well, kids don't always pay credit cards on time. Guess what happens to your credit? So be very careful, be very choosy on how you allow your credit to be used also. as far as like co-borrowers and being authorized signers and being part of your credit profile, because it will impact you. And guess what? Nobody cares. I don't mean that we don't care, but if you have something on your credit bureau, you can't just say, well, my kid didn't want to pay it. That hurts your character. That hurts your credit score. So just a pitfall to kind of be aware of, be very protective of your own credit.
Great, great advice. All right. And capital, we talked a little bit about that.
So yes, your capital is
Assets.
your assets minus any of your loans. So if you have, $1,000 in a savings account, but you owe $3,000 on credit cards, your net worth is a negative. So it would be a negative $2,000. So you wouldn't really have net worth at that point. So that's important to understand that, you're leveraging yourself and being overextended. Before you do that, it's important to think about what it's going to do to your overall financial picture.
Got it. Great. All right. And collateral?
So collateral, a lot of times credit doesn't have collateral, but if you're buying the home or you're buying a car, that is the collateral to secure your loan. If you're getting like a personal credit line or a credit card, those do not have collateral. So let's say you didn't pay on those. If you didn't pay on your credit card or you didn't pay on your personal line of credit, there would be no collateral to take away from you. But if you had a loan with collateral, such as a car or a home, then if you didn't pay or make the payments, then they could take away the collateral because you didn't make your payments.
Got it. All right.
And banks,
And
I was going to just say, banks don't lend. Collateral is part of the lending process for especially mortgages. A lot of people say, oh, I have a lot of equity in a house. We don't lend based on the collateral because we don't want to be in the business of real estate and have to repossess a house as real estate. So kind of keep in mind that it is an important part of it. But a lot of people sometimes think it is the, the car's worth more than this or the house is worth more than this, that it's a good deal.
Yeah. Yeah, absolutely. All right. We are going to move on. So what if they don't have credit history? How do we get started?
Oh, did we skip one or did we go back?
Sorry.
Applying for credit.
I'm getting
perfect. No problem. So applying for credit, how do you qualify for the credit you want? A basic application for any type of credit, we would have the customer. When you apply for credit, you have to give your social security number, your employment history, how long you worked, where you worked, how much money you make, the length of time is important. School counts, and also if you have gaps in employment, that could be an issue when you're going to buy a home. So like, let's say you have more than a 6-month gap of employment, you'd have to explain, why was there this gap? But employment's really important. And then what you save in your checking and savings accounts, the numbers, the balances, usually when you apply for a car and a home, they usually ask for that type of information. I don't think a car actually does. The cars they don't, and the credit cards they don't ask you, how much money do you have in your checking or savings. But when it comes to a home loan, it's nice to see that our customers, have saved a little money, that they have the ability to, make their rent payment and also save a little. And then by pulling the credit when you apply for a loan, we would see the information on your outstanding loans. I mean, they may ask you, tell us what your outstanding loans are, but what usually happens like on a home loan application, and I think most lenders, even on credit cards and auto loans, they don't ask you, how many loans you have and what are the balances. They just pull your credit, and
Right.
they see by doing that. So yes, that's really important. So remember, you might need proof of income and credit history. That's true, I would say, for any time you apply for credit.
Mhm. Now, when we're talking about applying for a loan, I have a question on here. How likely are banks to issue unsecured lending? So unsecured personal lines or loans. Is there an appetite for that?
There is, and there isn't. There is if you've got a lot of good credit and you don't probably need it. It's like anything else. But if you're starting out and you're trying to establish credit, a lot of times in universities, they will have secured credit cards for $300. If you can get your hands on one of those, absolutely do it. Get someone to put, like, the bigger banks especially, get someone to put $300 up and get a secured credit card for $300. Because that will help you. So for getting started credit, it's going to be very challenging unless you have a secured credit card. Or then again, we go back to the cosigner. If mom and dad want to sign for you, but you better pay that card on time because it's impacting their credit. Okay. I can't stress that enough, that they're doing that. So, and then when you're looking at credit, and this is a good, I'll just throw this in there. When you're looking at the credit score, you want to have 3 different types of credit. You want to have a credit card like a major MasterCard or Visa. You want to have a store card. That's a second type of credit. And a third type of credit is like an installment loan or a mortgage loan, because part of your scorecard is depending on the different types of credit you get, because each one is harder or not as hard to get as the other, because there's a difference in the way that you can get them.
Yeah.
Now, sorry. May I add a piece of information on that?
Absolutely.
Okay. I want to make sure I don't forget. This is like one of the most important things, I think. I always tell people when getting credit, you always put your account on automatic payment.
Yeah.
That way you ensure that you're not going to miss a payment, because even if you miss a $15 payment, it could adversely affect your credit score, and it wasn't worth the $15, because that could just really, maybe your score would go down like 100 points, which is not good. So that's just something I always tell my clients and people, even when you get your first credit card, just make sure there's an automatic payment. Yeah, that way if you
money in checking.
Yes, and well, the money, and money in your checking account to make your monthly, serious minimum payment. Even if it's just a minimum payment, that's okay, but at least you're not going to be getting a late payment. And the other thing is, if you build, like when you are building your credit, usually I think there's different cards that are easier to get than others. And I would say, even if you start opening up just 1 or 2 cards, the best practice is to charge on it. And if you can pay it even all off at once, that looks really good on your credit. Like if you charged once, like only charge once a year on a card and then pay it off, that would really help your score.
Well, I can add to that. Just charge $15, pay $15 off. You're establishing a credit history. So you want to show that you can pay something every month. So number one, I can't emphasize, and you guys laugh when I said it, make sure there's money in your checking, because that's a whole different rabbit hole. Okay. But when you pay, you want a credit history. So when you're paying that $15 every month, you're establishing a payment history, because we want to make sure that you're used to paying that. And that's and I'll go back to when you do your mortgage, one thing that we're going to verify with your mortgage, every mortgage, is your rental history. It's not on your credit report, but we verify, because we want to see that you could pay every month on time. If you've paid your rent every month on time, pretty much you're probably going to pay your mortgage pretty much on time. So again, it goes back to that character, your character issue of how you pay your bills.
Yes. All right. So, all right. So what if we don't have any credit? I know there was a question earlier too, is what's the best way to start credit, especially for our children? How should we help our children establish their credit as well?
Yeah. So if they're a student, it's, most major banks have the student credit card. I had all my kids do that, and it's the best thing. You also need to be careful for young adults that, a lot of credit companies like target them to open accounts. And then a lot of times they don't realize how important their credit is. So
Right.
I would say, as the slide says, you need to set up a checking or savings account. You can start off with the low credit limit. A secured credit card, like Mary had said, is like you go in and you give them your own money. Like, let's say it's $300 and you have a $300 line of credit. And even though you're using your own money, what happens is it's establishing a credit history on your credit report. So that's a very important card to get. If you can't get an unsecured credit card, I would go with the secured credit card. And then once you're available, or you can have available to you a major credit card like a MasterCard or a Visa, then you should take that card also. But it's not to start getting, a lot of cards. It's just to have at least 3 credit lines open. Yes. So and the best practice, like Mary said, is even if you open a card, charge $15 on it, and then pay it off, you've started your credit history, and you started a great credit history. You don't want to go open 3 new accounts, charge the max, because that's going to affect your score also. There is
Experian Boost. Guys, if you see that on TV, Experian Boost, that does work, where you report either your cell phone bill, electric bill, and that will automatically increase your credit. And this is again going back, length of time on a credit report is important. So when you're just starting credit, we understand that you don't have a lot of time history. So a trick is to go ahead and be an authorized signer on one of your parents' accounts that has been open for like 5 or 10 years. Because the trick is the credit bureau goes back and says, oh, they've had their account open 5 or 10 years. So there's kind of little tricks when you're getting into this, but we all know that too, that when you're starting your credit history, you're going to probably be in the low 700s because of the length of time that you've had on credit. And then I think that the number is 3, guys. You want 3 credit lines. Make sure you establish.
Yeah. Okay, so we do have 3 minutes left, and I believe this is our last slide. So if you want to just take us home in the next 3 minutes.
All right. So we won't have time for questions after 3 minutes. Is that it? Or is this our 5-minute warning?
This is your 3-minute warning.
Okay, sorry. Okay, 7 ways to improve your credit. Pay your entire balance on time every month. Use credit cards responsibly. Stay below your credit limits. The lower your outstanding balance, the better. Get out in front of bills, loans, and debt. So review your credit reports every year. Don't open too many accounts at once. Take care of any past due accounts sooner rather than later. And I will give one piece of advice. If anyone happened to have, like, let's say they look at their credit report and they had a collection account they didn't know about, maybe a doctor they moved.
Parking ticket.
A parking ticket, I don't think you can do I would not pay it right away, because that starts the derogatory credit clock running again. And when you pay on a derogatory item on your credit report, it lowers your score. That's for collection items. If it's a past due account, pay the past due account right away.
In other words, that if you have a credit issue, sit down and talk to someone who's familiar with the credit, because there's so many ways to the ins and outs of this that you want to make sure you're doing what's right for you individually. We can speak in generalities and tell you kind of what to look for, but it's so important when you're looking, especially at a mortgage, sit down with somebody who's knowledgeable, knows what they're going to do, and they're going to help you through this process, because this is a big piece of it, especially if you do have something on your credit. And experienced mortgage loan officers can help you through this process. They can't help you with the credit score. We wish we could, but we can help you through the process.
Absolutely. All right. Well, thank you, ladies. It was a pleasure. And we ended on time. If there is anybody out there who has a question, we will be more than happy to answer that.
Well, thank you so much. Very interesting stuff. I took a lot of notes, so time kind of flew. So thank you. Very
Yeah.
Antoinette.
We were